I think Joe is hurt. Angie Dundee, Ali's trainer, right next to me, is saying it. You may hear him. Down goes Frazier! Down goes Frazier! Down goes Frazier! The heavyweight champion is taking the mandatory 8-count.
Man, and just like that, interest rates got beat up this past week. Like a heavyweight brawl, mortgage interest rates took some serious body blows, starting Tuesday with the CPI, or Consumer Price Index report. The report showed overall inflation rose by 0.3% for the month of January, which was hotter than expected, and core rate, which strips out volatile food and energy, increased by 0.4 percentage point, which was a tenth higher than what the markets were expecting. Remember, CPI measures inflation at the consumer level, and the higher inflation is, that's not good for mortgage rates. On Wednesday, Chicago Fed President Austan Goolsbee tried calming the markets with his dovish comments. He stated that the current policy stance is already quite restrictive, and he supports cutting the Fed funds rate before the core inflation rate gets to the Fed's target of 2%. These comments worked, and in turn, the markets started to calm down a little bit, and rates were able to get themselves off the canvas. On Thursday, mortgage rates started punching back. When the retail sales number came out for January, they were reported at negative 0.8%, which was much worse than the negative 0.1% expected by the markets. And as a result, we saw mortgage rates fight back a little bit. But then on Friday, the PPI, or Producer Price Index report, came out. This measures inflation at the wholesale or producer level, and it showed that the PPI rose 0.3% in January, which was much hotter than the 0.1% expected. This was the knockout blow for week ending February 16th. I think we kind of got saved by this long holiday 3-day weekend. The markets are going to be closed on Monday in observance of President's Day. Let's pray to the loan gods that on Tuesday brings better news for the mortgage bond market and we see rates improve. So where did rates end up on Friday? Week ending February 16th, the 30-year fixed conforming mortgage interest rate was an even 7%, with borrowers paying 7/8 in discount points to get that rate. That's an approximate APR of 7.172. Govy rates, FHA and VA, are typically 3/8 to a half point lower than that, so you can do the math on those. Of course, I'm basing this on best case scenario. Your specific situation may differ. Check out the description in the section below in this video for a breakdown of how I base the rates. Look at this 3-month uniform mortgage-backed securities candlestick chart. This is the mortgage bond chart that 30-year conforming fixed rates hedge inversely against. You can see how prices have been deteriorating over the past 2 weeks. Remember, lower prices equals higher mortgage interest rates. You can see this huge red candle on Tuesday, February 13th. The loss in price was caused by that CPI report I mentioned earlier. On Wednesday, you saw a little bit of a recovery, and on Thursday, you saw a little bit more of a recovery. But then on Friday, we got hit with that PPI report, which knocked prices down, and in turn, interest rates went back up. Luckily, prices are sitting at this nice blue line, which is the 200-day moving average. That's typically a very good floor of support, which bond prices can bounce off of and move higher. Hopefully, this Tuesday, we get some nice bond-friendly news, which will cause a reversal, and we can see prices start to climb again and rates start to get better again. So, with that said, if you like this video, hit the subscribe button. Turn on the notifications so you get alerted to the next time I release a video. And also, I wanted to say thank you for watching, and until next time, let's get better, let's close more deals, and until the next video, I'll see you. Bye now.